Good morning, everybody, and thanks for joining. We'll get started. We're certainly delighted to have this group with us today for the first of what promises to be a pretty strong series on cryptocurrency trends and how FIs can turn a perceived threat into an opportunity. My name is Neil Doherty. I'm the VP of Marketing and Communications here at SRM, and I'll be assisting Larry, our presenter, during today's session. Definitely want to recommend that you use the Q&A feature here in Zoom to send us any questions you might have. We'll be capturing those questions and calling them out during the webinar if it makes sense in context or at the end of our session today, where we'll leave some time for any additional questions that may come through the Q&A function in Zoom. And we are recording this webinar, and we'll share it with you and any registrants who may have missed the live session. So we'll make sure everyone gets a copy of that link. So now the housekeeping stuff is out of the way, I'm pleased to introduce our featured speaker, Larry Pruss. Larry is a Senior Vice President at SRM, and he serves as our crypto lead and subject matter expert, consulting clients on this evolving space. Larry brings over 25 years of experience in payments and credit card space. He's worked with many leading entities, including Royal Bank of Canada, Scotiabank, and MBNA, Bank of America. And he's certainly often quoted in industry publications and regularly contributes articles and perspectives for consumption in the financial services arena. So very, very happy to have Larry here this morning. And without further ado, I'll pass it over to him to get started with this content for a highly anticipated session. So Larry, take us away.
Thank you, Neil, and truly appreciate everyone joining us this morning. Very excited to talk about this topic, fairly passionate about it. Obviously, this is geared toward financial institutions, but it should be good education for anyone interested in cryptocurrencies, blockchain, and decentralized finance, but we're going to look at it through the lens of financial institutions. We work with both credit unions and banks, so if I use the term members or customers, just appreciate that they're interchangeable, at least for this presentation standpoint, but we understand obviously the differences there. Before I get started, I'd like to share some information that I think is relevant. And this is actually from another consulting company, Deloitte. And Deloitte recently released their 2021 blockchain survey. And that was a survey of more than 1,200 global financial service executives. What they found was that 3/4 of them believe their organization would lose a competitive advantage if they failed to adopt blockchains and digital asset technologies. And I'd argue that, probably the other 25% that didn't feel that they would lose a competitive advantage might not have understood the risks and opportunities associated with digital assets. In fact, today, most of our clients are finding that their top deposit outflows, so their ACH outflows, are likely to a crypto exchange like Coinbase, even PayPal or Square, because both of them offer crypto trading. You've obviously got lots of pressure from fintechs. I mentioned Square earlier. They're now a bank. All of them are in the process, if not have already added crypto trading to their product offerings. Others like Stripe are launching crypto. May have mentioned Robinhood before. Robinhood, what we think about from an equity trading standpoint, Robinhood actually gets 50% of their revenue from crypto trading. And then another interesting stat is there's over 20,000, 15 to 20,000 ATMs, Bitcoin ATMs in the United States. So over 20,000 Bitcoin ATMs in the United States. Walmart has plans. They announced it, I want to say about 2 weeks ago, plans to install 8,000 additional Bitcoin ATMs. They've got 200 already installed in the pilot program. So, people's ability to get on the crypto rails is going to be increased pretty substantially. And then I also want to mention before we get started, there's really a huge first mover advantage in this space. There's a real demand in the marketplace for crypto solutions. One bank recently, Vast Bank, which is out in Oklahoma, they launched a crypto trading platform. So they were the first FDIC insured institution in the US to do so. And they experienced a 25% increase in their customer base 8 weeks post-launch. So again, let me just repeat that. They saw a 25% increase in their customer base within an 8-week period. And that's relative to a customer base that took them 40 to 50 years to grow. So significant demand out there in the marketplace. Those that meet that demand, I think, will be met with unparalleled success. So I do have to put a disclaimer in here. I'm not a financial advisor. Any ideas, opinions, views, predictions, forecasts, commentaries, or suggestions applied or expressed are for information, entertainment, and educational purposes, heavy on the entertainment. Shouldn't be construed as investment advice. Do your own research. stats in crypto industry become outdated pretty quickly. In fact, I'll speak to one of them this morning as it relates to DeFi. Assets tied up in DeFi changed by like $30 billion over the last 2 days. So I'll mention that as well. Here's our crypto team. So we've got experience with cryptographic foundations, industry applications, and we really focus in on the intersection of traditional finance and crypto. We've got a good understanding of the regulatory environment, various crypto digital assets. And we'll talk about a number of those today, but Patty, myself, and Keith are the crypto team. We have a lot of other people at SRM that participate in providing insight as it relates to crypto. We do a internal kind of, it's become a bit of an industry meeting called Crypto University. We do that every other week. That's been pretty useful, but we've been in this space about a year now, which doesn't seem like that long of a time, but crypto is kind of like dog years. It's a lot longer than you think. So I'm going to talk about cryptocurrency adoption. This is a chart that's about a year old. In fact, I found a more updated one. I might update this slide next time, but it compares the adoption of cryptocurrency to the adoption of the internet. So if you think back, if you were around in the early 2000s when internet was kind of taken off, or even late 1990s, we were all pretty sure the internet was going to be a big deal. We weren't really sure how big of a deal it was, but it wasn't easy to get on the internet. We had dial-up modems that would drop. We could get TCP, IP, and FTP, and all the different internet protocols. You had to, there were chat groups and folders, and if you wanted to download a picture, it'd take a week and a half. It was always dropping. And then fast forward to today with 5G technologies and on our cell phones, mobile devices, we get this stuff instantaneously. And we don't think about all the underlying work that makes the internet as easy and as accessible as it is. Crypto is a little like that. I mean, we're getting close to the point where it's very accessible and fairly easy to use, but 2-3 years ago, wasn't quite that as accessible. But we're seeing similar sort of adoptions. There's network effects with crypto, similar network effects with the internet. And in fact, this chart I mentioned was older. It's already outdated in that crypto appears to be growing at even a faster rate than the adoption of the internet. So for what that's worth. Today, actually a year ago, there were about 50 million crypto wallets worldwide. That number grew by 20 million. This year, there's 70 million wallets, estimated to be 200 to 300 crypto users worldwide. So there's more users than there are wallets. The reason for that is some wallets hold multiple people's digital assets. So a good example would be crypto exchanges are essentially a big wallet. So you could have multiple people with one kind of complex wallet. So hence there are less wallets than there are users. Interestingly enough, the US is not the highest user of cryptocurrencies. We really aren't. Turkey, Brazil, Colombia, Argentina are. Now, these are mostly countries with failing monetary systems. So for them, it makes a whole lot of sense. We'll talk about volatility in crypto assets, but that volatility is nothing compared to local currencies in those countries. So they're really adopting crypto as an alternative to their monetary system. The fastest growing countries are Vietnam, India, Pakistan, Ukraine, and Kenya. And really, these are emerging markets. So they rank high in large part because they've got huge transactional volumes and kind of peer-to-peer platforms. Crypto is a lot more diverse than a lot of people think or give it credit for. There's a lot of enthusiastic interest among minority and younger populations. Just a quick snapshot, and this was from Morning Consult poll. In fact, I've even seen some updates recently that lead me to believe that it's even more diverse than this, but 10% of whites own crypto, 18% of blacks, 20% of Hispanics. And then similarly, and this is from a Harris poll, 10% of the fully banked own crypto, yet 37% of the underbanked own crypto. So there's a lot of people who aren't fully banked. They're utilizing crypto for banking-like solutions, either because they don't trust banks, either because they haven't found the access to banks that great, or credit unions for that matter. But a large number of the underbanked, or a significant amount of the underbanked, are using crypto for financial solutions. And then, this was from the University of Chicago, recently quoted that women investors of color seem to be drawn to crypto over traditional stocks, again, because they were viewed as more accessible. And I tend to agree with that. Crypto, used to have a high barrier of entry, but that barrier of entry is really coming down. A lot of people are getting into crypto. A number of companies have made that very easy, whether it's PayPal and Venmo, whether it's Square, with their Cash App or others, or even Coinbase for that matter has made it a lot easier to sign up and get crypto accounts. So I always get questions about like, well, are we too late? Crypto, we've been hearing about crypto in the news, for the last year. My answer to that is no. You're definitely not too late to the party. Kind of when this all started back 2008, 2009 with the early innovators, Satoshi Nakamoto and the cypherpunk movement, those were the folks that were ahead of the curve and developed crypto. And then the early adopters, which about 13% of them, I would say these are our friends that we probably wish we'd listened to. I had a couple of them try to get me into crypto 10 years ago. They're doing quite well. Not as I'm not doing nearly as well as they are. I wish I had to listen to them a little bit more carefully. But where you all are in terms of your crypto journey, or I suspect a large number of you are, as well as I am, is that you're taking the time and effort to learn about this, which is great because you're not too early and you're kind of in that early majority. So we're seeing a lot of interest from financial institutions. We're seeing hedge funds. We're seeing individual investors, but it is still very early. We've got about 20-25% of Americans that have investable assets are currently invested in crypto. So that's still not a lot compared to equities, which I think are more like 60%. And then when in the next year or two, we'll see kind of the late majority get in as more companies, more governments, more sovereign wealth funds, and then ultimately we'll get mass adoption. But you're definitely not too late. And now is the time to start thinking about crypto solutions, because a number of crypto solutions, particularly in the banking credit union space, are coming to market with anticipation that next year we will see over 1,000 financial institutions launch some sort of a crypto trading platform or solution. So why should you care about crypto? Well, if you're a credit union or a bank, a community bank, large bank, whatever, crypto is going or has gone mainstream. So again, while early adoption, enough people are gotten into it, it is considered mainstream. So 20% of Americans own Bitcoin. This is from a survey from NYDIG. There was a similar survey done recently from Visa that also supported these numbers. And I've been talking to financial institutions, and I find similar, as well as just kind of the general public. So about 20% of Americans, 22% own Bitcoin. Probably, if you consider other crypto, probably 25% or so. So ownership is growing. Interestingly about that is, there's a saying in crypto, not your keys, not your crypto. And we'll talk about what the cryptographic keys are, but they're what really gives you access to your crypto. And if you lose those, or those are hacked or stolen, it's a big deal. You won't have access to your crypto. So vast majority of people who own crypto actually would choose to store it with their trusted financial institution, which again speaks to the opportunity. I mean, there are some hardcore folks that would want to hold it themselves, but like if you're holding your own keys, you're really acting as a bank, which means that you've got to kind of have the paperwork, you've got to have the backup, you've got to have personal security is even a consideration. So most people don't want to do that and would choose to store those cryptographic keys at their financial institution. I'll give you a good example. If you happen to be one of those people that had your own keys and you didn't tell your wife or kids about it, and you walked down, got hit by a bus, well, your wife and kids would lose access to that crypto because they wouldn't have access to those keys. So again, pretty important safety concerns. Well, why is this relevant? Well, this is relevant because not only is there an opportunity to offer to custody those keys on behalf of their clients, but the vast majority of people who do hold crypto would actually switch to a financial institution that offered crypto related products. So, 20-25% of majority Americans own crypto. So 20 to 25% of your clients own crypto. 80% of them would love to store it probably with your institution, but 70% of them would switch if you didn't offer it and one down the street offered it. So again, that speaks to the early mover advantage. You could wake up next year with 1,000 institutions launching this. If there's one that competes with you, you don't launch it and they launch it, you could wake up to losing 17, 18% of your client base over the course of a couple of weeks. And so that is a big deal. The opportunity to attract also new clients is huge. I'll illustrate this with PayPal. So PayPal started their crypto journey, well, a lot earlier, but they launched crypto product in end of 2020. When they launched, literally the next month, they had 48 million users started buying crypto on their platform. The following quarter, they added 14.5 net new accounts. And in fact, I think 2021 over 2020, they were up 100% in net new customers. So, and I think that's due in large part to them offering crypto trading solutions. And obviously their revenue has gone up pretty significantly as well. Talking about revenue opportunity, if you just look at the revenue with Bitcoin alone, it's huge. There's more than 5 billion of daily Bitcoin trading volume. And you think that most of that's going through the crypto exchanges. The average fee, and it varies by exchange, but the average fee is about 2.3%. That represents anywhere from 42 to 50 billion of fee revenue, non-interest income opportunity if you were a financial institution. So even a small slice of that would be significant for an FI. We know that one of the top 3 financial institutions recently looked at their ACH outflows, so their outflows from their deposit base over the last 24 months. They found that Coinbase was their largest outflow by a factor of 2x compared to the next outflow source. We're seeing the same. Everyone we talk to, if they're looking at their outflows, they're seeing Coinbase, PayPal, Square, Kraken, Binance, all the other crypto firms in those top lists. So they're losing a fair amount of deposits, which is a source of funding for loans to fintechs and crypto exchanges. In fact, one of our team members was talking with a credit union that was losing about 1.5 million per month in outflows just to Coinbase alone. So again, Coinbase is just one crypto trading firm. If that institution was able to capture 50% of those outflows because they had a crypto offering, and assume they got somewhere between 100, 150, 200 basis points, they'd be, instead of losing deposits, which means if they can't make as much loans, they would actually be gaining trading revenue of about $17,000 a month, over 200 grand a year. And again, that's just capturing 50% of that volume that's just going to one of the one of the exchanges. And finally, there's an opportunity to more deeply engage with your client that I think is incredible. PayPal saw the number of their logons to their app more than double after adding crypto trading. For anyone that trades in crypto, myself included, I'd probably be embarrassed to tell you how many times I checked the prices with crypto. And it's one of those things that trades 24 hours a day, 365 days a year, 7 days a week. People are always checking those crypto prices, but that gives you an opportunity. If you're a financial institution, you've got a mobile banking, mobile app, online banking, whatever, in your crypto, you're trading crypto for your clients. Your clients are going to go there. You're going to have eyeballs on that app many, many more times than you do today. And that's an opportunity to educate your clients, cross-sell them other sorts of products and services. So the level of engagement you get by offering a crypto solution is pretty significant. So the big why should you be interested in cryptocurrencies? One, as I mentioned already, defend your source of funding, which are your deposits. Drive interest, non-interest income. We'll talk about the interest income aspect of it because you can lend against crypto as well. People can borrow against crypto. Opportunity to gain clients in market share, like Vast Bank did. I use that example, put on 25% net new customers in the course of 8 weeks. Increased client engagement. I mentioned PayPal, but every crypto firm, anyone that has crypto trading has seen the same thing where that client engagement just more than doubles. And then avoid being disintermediated. We'll talk about that in a bit, but there's a whole alternative financial ecosystem that has grown up out there called decentralized finance. And it's doing to the financial institutions what Uber did to the taxi industry. So as you know, Uber connects people who have cars to drive with people who need rides, and they do that primarily using software. Well, decentralized finance does the same thing with banking products. So banking at a very simplistic level is connecting people who have money to lend with people who have borrowing needs. So if you can connect them with software and avoid all the intermediary pieces, which is, the branches and employees and computer system and compliance officers and boards and all of that, and both sides of that trade tend to get a better price. So that has been a booming business, and it's one not to ignore. And we'll talk about that in a bit more detail. But these are kind of the big reasons why you need to be kind of engaged with this sector. So what is cryptocurrency? At a broad level, it's digital assets that are designed to work as a medium of exchange or a store of value. And we'll talk a little bit more about what that means. They exist on a decentralized digital ledger. A lot of times it's called DLT, digital ledger technology, if you've ever seen that acronym, but we're really talking about the blockchain. They're not controlled or issued by a central authority generally, and they also tend to be community developed and governed. They're protected with cryptography and leverages public and private keys for any change of ownership. And it is, depending on the day you look at the crypto prices, it's bouncing around a $3 trillion asset class, which I think by comparison to silver, I think is like 6 trillion. Gold, I think is about 12 trillion. So it's becoming a pretty big asset class compared to others. Now you compare it to equities and bonds and things like that, it's not very big, but it is growing and it's starting to catch the attention of regulators as well as people who want to invest in it. The first cryptocurrency I think I mentioned before was Bitcoin. It was created by Satoshi Nakamoto. Don't know if that's a he, a she, or a group of people. It looks like it was a pseudonym. It was created in 2008, launched into wild 2009, has been growing ever since. And it's also worth mentioning that cryptocurrencies are treated today for tax purposes as a commodity. Not in every country. Some countries, they do treat it as a currency, but our country treats it as a commodity, which does add some complexity for everyday spend. So different use cases. Why are people getting into cryptocurrency? Why are your members, why are your customers coming to you and saying, hey, we want to be able to hold crypto, trade crypto, buy crypto? So 3 of them primarily. Store value, and this is usually the Bitcoin argument. Bitcoin could be used for transactional purposes as well, and there's some growing use for that. But primarily people get into Bitcoin as a store value. And part of that is because it's hard capped. It's got only 22 Bitcoin will ever be minted or mined. Mine's really correct. There's 18 million Bitcoin, roughly 18 million today in circulation. So in the amount that gets mined at a decreasing amount. So you've got increasing interest in this asset class with more people looking to buy it. There's not any increasing supply, so the price goes up. It's kind of similar to artwork, where artwork, you think about Monet, rich people would invest in that. They'd buy it as a hedge against inflation because the price always goes up. They're not making any more Monets. And in fact, the supply tends to get decreased over time because of loss, theft, destruction. Same with Bitcoin. About 15% of all Bitcoin has been assumed to have been lost due to lost keys or whatever. And, it's about $150 billion or so. That's a lot. So, if you lose those keys, again, pretty important. And that speaks to the opportunity for holding those on the behalf of your clients. It's decentralized, censorship resistant, immutable, meaning you can't change it, can't change the blockchain. And there's network effects just on how quickly it grows. So store value is one of those primary arguments why people get into crypto. And most of them tend to flock towards Bitcoin for that. There's lots of different cryptocurrencies, probably 20,000 currencies / tokens out there. There's probably really only a dozen I'd argue they have real business solutions. The rest are purely speculative, and we'll talk about speculative next. So you look at these year-to-date returns, and this is on the top four based on market cap. So BTC, which is Bitcoin, 107% year-to-date. ETH is up 471%. ETH is Ethereum year-to-date. BNB, which is Binance Coin, up 1,400% year-to-date. SOL, which is Solana, up almost 1,400% year-to-date. I mean, those are outrageous returns. Some of those have been pretty consistent for a long time. Bitcoin, I think, has done about 200% plus year over year for the last 10 years. So, there's no doubt you're getting questions from your clients about wanting to get into this as an alternative asset class, because that doesn't, equities doesn't come close, gold doesn't come close. And as we know, we're seeing inflation right now. So the value of the dollar relative to commodities, things you can buy, is kind of dropping, although the dollar's been doing a little better the last couple of days. But people get into this from a speculative purpose and to protect their wealth. Transactional would be the third one. It's probably the most interesting one from a banking standpoint. So transaction solutions as it relates to cryptocurrencies. There's a lot in the international remittance space. El Salvador, which recently adopted Bitcoin as legal tender. They're saving about $500 million a year for their citizens as a result of being able to leverage Bitcoin for those international remittances versus a Western Union that might charge 15% or whatever. Real-time settlement. So this is being used quite a bit. Settlement, as opposed to, think about like the Fed now, which is coming, but ACH, SWIFT, wire transfer, all those things take a few days to clear. Crypto clears immediately, and it's real time and it's final settlement. There's no backing it out unless whoever you send the money to agrees to send it back. We're seeing use cases in payments. There's a company called Flexa that's getting very involved in this space, providing solutions at point of sale for people to buy things with their crypto. I think we're going to see stable coins play more of a role in that. And then decentralized finance. I mentioned this one earlier as a threat, but decentralized finance apps or DApps are being conducted. They're conducting lending, borrowing, trading, insurance, derivatives, synthetics, all the things that banks have traditionally done. So you can't talk about crypto without talking about blockchain. I'm not going to go into a real deep technical explanation of what blockchain is, but blockchain basically a bunch of computers that are distributed all over the world. These computers are known as nodes. They all hold basically the same copy of the blockchain, and they cross-reference each other to make sure that they've got the latest copy. The one that tends to have the longest chain tends to get consensus, and that's the one that everyone else kind of copies off of. Best way to think about blockchain, the way I think about blockchain, is think about a train or rail system. So, lots of railways all over this country. Different trains can ride different rails, different rail companies even. And think about crypto as the train that rides the rails, and the rails being the blockchain. It allows the crypto to kind of move from place to place and have a place to kind of sit your train. And we're going to talk about public and private keys, and that's what gives you access to your crypto. And the way I look at it is, if I'm going to go on a train ride, I'm going to purchase a ticket, and then I'm going to get a receipt. That receipt allows me to show my boss that, hey, I've scheduled a trip on a train or an airline for that matter, and here's a receipt to prove it. I'll submit it for my expense reduction, whatever. But that receipt is kind of the equivalent of a public key. So you can share it with others just to prove that you own the right to ride that train or the right to access your crypto. The ticket is what gets you on the train. The ticket is your private keys. The ticket is what you don't want to share with others. Another analogy would be the internet. And think about emails. And we send emails to each other. I need to know the email address I'm sending it to. That's kind of like the public key or public address. I could send an email the same way I could send crypto, but I'm sending it from my public address so you can know my email. But the password to get, to send an email, I have to know the password to get into my email system. Internet could be looked as the rails. There's a number of different analogies, but what you need to know is that blockchain is the foundation that crypto is based upon. You can have multiple blockchains out there. for different crypto solutions. You have different crypto that can ride on different blockchains. And as an example, cryptos that might exist on multiple blockchains. So USDC, which is a stable coin, uses the Ethereum blockchain, also uses the Algorand blockchain, uses a Stellar blockchain, much like a train using different companies' rail systems. What you need to know with blockchain is they're extremely secure. A good example would be Bitcoin. That Bitcoin blockchain has never been hacked. I mentioned earlier, 15% of all Bitcoin appears to be locked up forever, $150 billion. If you could find a way to hack into Bitcoin or the Bitcoin blockchain, you could grab yourself $150 billion. That's a pretty big incentive. No one has figured a way to do that yet. There's questions about with quantum computing, will that change? Maybe, maybe not, but they're constantly updating the security protocols with all of these cryptos. In fact, Bitcoin just got more secure with an upgrade called Taproot. I'm not going to go into those details, but suffice it to say, they're like anywhere kind of always staying ahead of the hackers. So when you store crypto, you don't actually store it in a wallet. You store the keys in the wallet. Your crypto, again, exists out on the blockchain. It exists in a ledger somewhere, and you hold your keys, but you can hold your keys in the equivalent of a wallet, like a digital wallet. Two types of wallets: custodial wallets, non-custodial wallets. Non-custodial wallets are where you control those keys 100%, which is a little bit more complex, requires a little bit more work from your standpoint. A good example of a custodial wallet where you don't control your keys would be third parties like the exchanges. So they actually hold your keys on your behalf and allows you to sell and trade crypto very quickly. You don't have to transfer it onto an exchange. It already sits on the exchange, or the exchange already has access to it, actually sits out there on the blockchain. But that's the difference between kind of the custodial wallet, non-custodial wallet. Again, I already talked about public and private keys, but that's what gives you access to your crypto. And in terms of wallets, there are wallets called cold wallets and hot wallets. Hot wallets are typically software-based. A lot of times they're apps on your cell phone. They're always connected to the internet, or usually connected to the internet. It's much more accessible, allows you to trade a lot more quickly. But with anything connected to the internet, you have vulnerabilities of potentially being hacked. For those of folks that are really concerned about that, typically hold their cryptographic keys in a cold wallet. Again, the crypto sits on the blockchain, but to get access to it, you have to have your keys. They'll store those keys in a cold wallet that will not be connected to the internet. If you want to trade crypto or send crypto, you're going to have to connect that to the internet just briefly to sign the transaction using those digital keys. And then you can move that crypto from basically like one ledger to another. It's just, they just update the ledger in terms of who has ownership. So what kinds of crypto are there? We've already started talking a little bit about this. Coins, really only one coin out there, Bitcoin, the original Bitcoin. Most other coins are considered altcoins. Ethereum is a good example of that. Bitcoin, by the way, has about $1 trillion market cap. Ethereum, I think, is about 500 billion. So that's the second largest. Lots of different altcoins out there with various use cases. Stable coins, which I think are going to be real interesting in the future for potential payment mechanisms. There's a lot of talk in Congress. President's Working Group recently came out with some suggestions about stable coins. Stable coins are typically, they tend to be pegged to an underlying asset. There's a lot of them in circulation, about 200 billion, but with daily trading volume as high as 500 billion. So they often represent half of the total crypto trading volume at any given time. They're used as digital cash that sits on exchanges in order to quickly buy other crypto assets or for transacting in the decentralized finance space. They kind of act as a proxy for cash. They are often backed by, again, cash or cash-like equivalents. In the US, there's a lot of talk about requiring them to be backed by, on a one-for-one basis, by US dollars or US treasuries. Some hold corporate debt, other sorts of things. I think we're going to eventually see stablecoins be used for everyday transactions because they're stable, because they're pegged to an underlying asset like US dollar. They don't change a lot in value. So that's one of the big issues with transacting with, say, like Bitcoin is Bitcoin's going up or changes so much in value. You know, your coffee you might buy today that costs you $4 might be worth $10 tomorrow because Bitcoin went up. And then you think, oh my gosh, why did I sell that? Or if you bought Bitcoin at $20,000 and now it's trading at 60,000 or wherever it is today, and I buy a cup of coffee, I've got a taxable event because I've just spent some of my crypto, and crypto is treated like commodity, and I've got to report that to the IRS. With stable coins, not quite the same sort of setup because there is not that change in value. You can use that stable coin without having to worry. Again, I'm not a tax advisor, but in theory, without having to worry about the tax consequence of spending that. In addition, merchants could like that quite a bit because it's conducted over the blockchain as opposed to conducting over, say, the MasterCard or Visa rails. So they could avoid the merchant fees, which run anywhere from 300 to 400 basis points. And a stable coin transaction could cost anywhere from 10 to 20 basis points. If you're working with a Flexa, maybe 40 to 50 basis points, but a whole lot less expensive for a merchant to transact with a crypto transaction than, say, over a MasterCard or Visa rails. Now, not to say that they're not going to be involved in this. I know they're doing a lot with crypto as well, but I think we're going to see stable coins used more for everyday transactions and probably ultimately as a proxy for a central bank digital currency. And we'll talk about that in a second. Non-fungible tokens, just to quickly touch on that, non-fungible tokens are basically digital titles to real or virtual assets, currently being used a lot in the art and music industry, often to provide royalties for each use of an item. I think we're going to eventually see it used as digital titles to real world assets like mortgages and automobiles, in which case could eliminate things like title insurance. Think about the hassles that are involved. Why do we have to have a title that sits in a safe deposit box somewhere, and all of that has to be researched prior to selling a house? When you could say, hey, I've got a non-fungible token tied to it, I can prove that it's mine from an ownership standpoint, and we can do that transaction kind of immediately as opposed to having to wait for the research to come back to see if I actually own that house. Central bank digital currencies, there's a lot of movement in this space. Over 90 countries are investigating developing their own central bank digital currencies. The best known is the digital yuan or the e-renminbi, digital renminbi. That's China's. China's about 10 to 15 years ahead of everyone else in terms of central bank digital currency. Everyone's working on it. The expectation is most of them will get rolled out in the next 4 to 5 years. They do provide certainly governments and central banks additional functionality that hard cash and or even electronic cash doesn't have today. So as an example, central banks can set expirations on their currency to force spending. They can apply premiums and discounts. They could apply tax automatically, so there would be no tax leakage. They could track spending habits. They could maintain capital controls. They could instantly provision citizens' mobile wallets. Think about what happened during the pandemic and how long people had to wait for that money to get out and how inefficient that process was. Well, if they had a central bank digital currency, they could send that immediately. Our own government is working with MIT. The Boston Fed in particular have been working for a number of years. We're expecting a report on the central bank digital currency probably in the next week or two, but I've been saying that for a while. It's supposed to come out originally in the summer. There's been some delays that may get delayed yet some more. I think where we're going to see a central bank digital currency come out is probably in the next year or two at the wholesale banking level, and then for everyday transactions and for transactions at most financial institutions, that would be done with stable coins. But that gives you a little bit of idea of kind of where the digital asset space is headed. I'm just going to touch on this briefly. Illicit transactions as percent of overall crypto has dropped very significantly over the years. When crypto first came out, there wasn't a whole lot of use cases, and a lot of it was used for illicit transactions, primarily because most people thought the blockchain was anonymous. Turns out it's pseudo-anonymous, and there's a lot of great companies out there, Chainalytics, CipherTrace, Elliptic, and others that trace on-chain movements of cryptocurrencies. In fact, they've gotten very good at it to the point where most government agencies, Department of Homeland Security, Department of Justice, IRS, etc., much rather track a crypto transaction than trying to track US dollars, which are a lot more anonymous. So what we've seen as a result is criminals have moved away from it because they realize this stuff can be tracked. We do see it used somewhat for ransomware still, but in terms of overall transactions, crypto is now less than 0.25%. You compare that to US hard currency, which is about 7 to 8%. It's a lot less crypto crypto is used a lot less for listed transactions. So how can financial institutions adopt cryptocurrency or blockchain concepts? Well, there's a number of use cases, and these are real world cases. There are already financial institutions that have these in market today. So this is not vaporware. It is here. And again, I mentioned probably 1,000 solutions will be coming to the market next year. So you will not be alone. A US bank recently got into it in terms of custodial services, again, holding those cryptographic keys. It's very similar to like a digital safe deposit box. And if you're holding your members, your customers' keys, you can charge the equivalent depending on how much of funds you're holding them on their behalf. It could be anywhere from free to maybe 40 or 50 basis points. But it's really important to know that you have to have some level of custodial services to offer some of these other things. So if you've got access to those keys, you can do some unique things like lending it against a crypto. Certainly trading comes into play. The types of custody are very important. I'm not going to go into those details today, maybe in a further seminar. But trading is a huge use case. So Vast Bank, I mentioned earlier that they picked up 25% of their new customers by getting into trading. I think they trade at 1% fee, which is still pretty substantial. Most trading revenue would be anywhere from 100 to 300 basis points. But think about the amount of outflows on your ACHs and what you could capture back and gaining 150 to 200 to 300 basis points on that. It's a lot of money that banks and credit unions are missing out on today from a revenue standpoint. Rewards programs, Quonic Bank in New York is a good example of one that launched debit rewards cards. Rewards can be paid on both debit and credit cards. Those that have launched in the market, to give you an idea how popular they are, have had wait lists of over 100,000 people waiting for them. You can even pay interest in crypto. So you think about ways we reward customers and members today. We do that by, airline points or even cash back. I mean, airline points aren't worth a whole lot right now, probably won't be worth a whole lot for a while given the pandemic, but cash back is probably pretty popular. Well, I know if I take cash back, even if 2 or 3% cash back, well, that adds up. I know also that prices are going up in price, and my dollar buys less and less every day, it seems. So would I rather have cash back, or would I rather have crypto with Bitcoin going up 200% year over year? Well, heck, I'd rather have Bitcoin. It doesn't cost you as a financial institution anymore to give them Bitcoin or crypto versus cash back, but your members, your customers are sure going to like the cash or the crypto aspect or crypto option. Also tends to attract a lot of younger folks, which are obviously the future of being able to sell other sorts of products and services for a financial institution. Mentioned lending. So there's two aspects to lending. There's lending to the crypto industry, which is quite lucrative. Silvergate Bank, which is in California, got into this pretty early on. They grew their asset base over the course of a year by $10 billion. So that gives you an idea of the demand. That'd be lending to crypto providers that might need liquidity. They might need to buy mining equipment. They might need to set up servers, whatever. Generally pretty good investment, and you get pretty good yields on that as well. The other option is lending against crypto. So as your customers and members start to build up significant assets through trading, and most of that trading is conducted in a way that is kind of a walled garden. So because of AML, Know Your Customer, Bank Secrecy Act, all of that good stuff, a lot of the implementations we're seeing, at least initially, are going to be around kind of a walled garden approach. So you can buy, sell, and hold, but it all stays on that platform. It doesn't move outside of the bank or financial institution. So if you want to buy crypto, you buy it with money from your checking account. If you want to sell crypto, that money goes back to your checking account. So there's no issues with money laundering or anything like that. But as your clients start to build significant crypto assets, and it doesn't take long given how fast crypto has been moving up, they're going to want to be able to leverage that for everyday needs, whether it's to buy more crypto or more likely to buy a house or buy a car or send kids to college. So I'll give you an example. If I had, say, $100,000 in crypto, which sure would be nice, not saying I have that, but if I did, and it was with my bank, and I wanted to borrow against it to say send my kids to college, and I needed say $50,000 or whatever, The way it would typically be done and is being done today in the DeFi space is this being done as an over collateralized loan. So you would make the loan to me, but you would only make me a loan 50% of the value of the asset. So you would lend me $50,000 on my $100,000 of Bitcoin. You'd write the contract such that if the Bitcoin fell in value, you would liquidate it on the open market to protect the amount that you lent to me. I wouldn't get my crypto back. I would still have the money that you lent to me. You would be made whole from a bank standpoint, so there's no risk in that. I could choose to pay back my loan and get whatever remaining crypto is there, or if I didn't pay back my loan, then you would just sell the rest of the crypto. But anyway, it's a low risk loan. You could probably make 500 to 800 basis points on it with little to no losses. That's what crypto lending looks like. That's the way it's done in the DeFi space today. It's not any different than kind of lending against equity or stocks, right? So that happens pretty regularly in that industry where, I don't want to cash out of my equity positions, but I want to borrow against it. And, if I'm doing it with Bitcoin, I don't want to cash out because I don't want a taxable event, but I want to be able to use some of the liquidity of that. So that's lending in short. I talked a little bit earlier about stable coins. We're going to see financial institutions being allowed to issue stable coins. President's working group came out and said that they want only financially insured institutions to be able to have that right, which would mean banks and presumably credit unions, since you're insured by the NCUA. FDIC obviously insures banks, but the benefit there could be is that if you issue these stable coins, they would have to hold those funds one for one in your institution. So when they return the stablecoin gets burned, and then you can give them back their deposits. But those deposits presumably could be lent back out. And the why I say that is that it could be a source of lending, is that similar to regular deposits in the financial institution today, you lend those back out on a fractional reserve lending standpoint. You could potentially do the same with those assets of the stablecoin. Now, if they're really backed one for one and you're required to keep that backing, then there'd be no need for it to be FDIC or NCUA insured. So I'm suspecting that the regulators might allow that money to be used for other purposes, which means it could be potentially a source of funding for loans for the financial institution. More to come on that. I think that has to be worked out still, but there could be a fair amount of opportunity or upside for those institutions that are able to issue stable coins. And then finally, outside of crypto, just using blockchain technology, a lot of opportunities there. JP Morgan got involved early on with that to develop their own permission blockchain with their own actually internal coin called JP Morgan coin. They used it to speed up settlement periods and do kind of peer-to-peer solutions. Again, could be an option for lots of options for blockchain solutions outside of crypto, but some banks are looking at blockchain solutions that aren't really tied to crypto. So I mentioned decentralized finance, and I know we've got about 15 minutes left. Decentralized finance or open finance is really peer-to-peer financing using crypto without any third-party intermediaries. It's open, it's transparent, permissionless, trustless. Decentralized has compostability, meaning that these financial applications can be used almost as financial Legos. You can come up with some really creative financial solutions by reusing them. They're open source, so this stuff is very easy to build and come up with new solutions. It cannot really be controlled from a government standpoint because it's in the internet. When these apps get posted out to the internet and on the blockchain, they exist. You really can't take them down, and they can be used by whoever wants. These DeFi applications or DApps are growing list to include things like, as I mentioned before, borrowing, lending, trading, payments, even insurance. We've seen a tremendous growth in the past year alone. It grew from basically 20 billion to it was 113 billion back a couple of days ago, although in the last 2 days has dropped $30 billion. But that's money that's tied up in DeFi. If you kind of extrapolate that out, I would expect in a year, probably that to be 500 billion, a little farther out, $1 trillion, and then maybe $2 or $3 trillion. Then it'll start impacting your business. When it gets to a $500 billion mark, you're going to notice it because you're going to be having less loans. you'll be doing less payments. You'll see less lending, less borrowing. And so this is a big threat to financial institutions. Does not mean that there aren't opportunities to onboard clients, maybe provide them with alternative solutions for maybe underbanked that you can't provide them a solution today because of either credit history or some other reason. You could potentially give them a DeFi solution, provide them with an AML, know your customer on ramp, and then that would allow also when that off ramp happens, maybe to have those funds be verified, and then ultimately you could get them into more traditional financial solutions. But the threat here is that this stuff is being done with software. It's a lot more efficient, the transactions, than typical bank or credit union transactions. So you're going to have to find a way to compete with this. Real quickly, how does the government view crypto? I'd say they're warming up to it. Initially, it was hard to tax, particularly small transactions. Larger transactions are much easier to track, mostly because those transactions are coming through the exchanges, and all the exchanges are required from a reporting standpoint to report those to the IRS, much like any kind of a large transaction at a bank. So, anything over $10,000 also has to be reported to IRS, just like you would do a suspicious activity report today. Crypto does, certainly in the DeFi space, create some AML, know your customer, know your transaction, BSA challenges, but that is also being solved, particularly with some of the on-chain analytics. Crypto fraud is not nearly as common as been suggested, so that is not really a concern as it might have been in the past. It is hard to implement capital controls. So today I could transfer $100 million overseas at the push of a button. The government could not prevent that from happening. That is a concern of the government. I don't know they're going to have a solution for that anytime soon, but that is certainly a concern. However, governments, in particular Congress, and given the makeup of Congress, are starting to understand that there's real efficiencies with DeFi and crypto, and also the ability to provide solutions to the underbanked, and also, how diverse the diversity of cryptocurrency. So with all of that, Congress is saying, hey, look, there are people who aren't being served today by traditional finance. If crypto is a way and DeFi is a way to serve those people, then that's a good thing. If it makes our financial system more efficient, then it's a good thing. So government at this point is not going to shut any of this stuff down. Will regulation change or impact crypto? Absolutely. Although there isn't a lot of regulation right now, we did see some guidelines come out from President's Working Group. They basically asked Congress to provide some guidance around stablecoin. The OCC has provided guidance to banks via some interpretive letters. The NCUA is working on doing similar. But part of the problem is there's no one regulatory body responsible for cryptocurrencies. We might see that eventually. A lot of it right now falls on the SEC and the CFT, Commodity Future Trading Commission. Congress has formed a number of working groups that have about a year to evaluate crypto from a regulatory standpoint. The recent infrastructure bill had some regulatory language in there to address trying to capture taxes from anyone that might be, quote, a broker. They've got a very broad definition of what broker is. That has to probably get cleaned up. A number of folks working on that. The regulators that are in this space include the SEC, CFTC. I mentioned both of those earlier. IRS obviously classifies crypto as property. Office of Comptroller is very involved. The NCUA is very involved. Department of Justice, FinCEN, FATA, FASB, even an Accounting Standards Board. All of these play some regulatory role in crypto. That said, there's not a lot of regulation. And in terms of financial institutions, there's really nothing saying you can't get into crypto today. It's how you get into it, how you work with your regulators, the type of solutions. All of that has to be kind of explained and defensible, but as long as it is, it's perfectly safe to get into crypto from providing a solution to your members and your customers. There are a number of leading vendors in this space. There are others. These are the ones that we primarily see out there that have various different solutions, some more eloquent than others, some easier to get to market than others. We would endorse one over the other. But all of them have some good valid solutions. So that's kind of the folks in this space. There may be others, but those are the ones that we tend to see. Just in summary, The real risk here is doing nothing. Cryptocurrency adoption is increasing. 25% of Americans already own crypto today. A year from now, that's probably 30 to 40%. A year from then, we're talking probably 60, 70%. And then it starts looking like adoption with like equities. You're definitely not too late. The risk of doing nothing includes losing business and being disintermediated. So the losing business part is what happens if a financial institution down the street launches something next year and you don't have something launched. That's a problem. You could be losing that 18, 20% of your client base. As more people get into it, that risk becomes larger. And then you could run the risk of being disintermediated with DeFi. That's not a solution that is going to be solved for anytime soon. That's going to be regulation. That's going to be figuring out ways to maybe work within the DeFi space to maybe offer clients that don't have financial solutions today as maybe a temporary way for them to build their assets and then bring them back into traditional finance. But I would say as it relates to DeFi, you need to find ways to become more efficient in terms of all processes. Opportunities here are substantial revenue, new clients, increased engagement, and an early adopter advantage for anyone that takes advantage of that. And your early adopter advantage is limited to probably the next 6 to 9 months. Outside of that, enough people are going to be in the space that you might lose that advantage. So get moving on it if you want that early adopter advantage and to have similar results as what Fast Bank has seen. I mentioned different custodial wallets for different types of usage. Illicit usage is dropping fast. DeFi is competing with traditional banking solutions. Regulation will likely add a legitimacy, and the solutions and picking the right vendor is going to be critically important. There's more information that you can get. There's a great course that MIT teaches with Gary Gensler, who's the head of SEC. You can find that on YouTube. There's also a great link. We'll send this out later, but on decentralized finance with Jim Bianco. So with that, I'm going to turn it back over to Neil. I want to thank everyone's attention today. We're really passionate about this space. It's going to change finance, and we'd love to be part of your crypto journey.
That's awesome, Larry. And a couple of questions came in, and I was hoping maybe you could just hit on shortly with the time we've got left here. One question that came in was, do you have any idea how many community banks in the U.S. are currently offering custodial service, or just kind of a ballpark in terms of where that is from a sophistication or growth standpoint?
So not a lot of community banks. NYDIG announced one, I want to say last week or the week before. I remember the credit union was Unified Federal Credit Union. The bank, I'm not recalling, but a number of community banks are looking to launch. I mean, we've got some specific examples. Obviously, wouldn't want to give them the names and steal their thunder, but a number of them will be launching. I think we'll see a couple before the end of the year. Next year, we'll see a lot more. But those examples I provided earlier, which were a lot of larger financial institutions, those were kind of the early movers, but community banks are definitely looking at getting into this space.
Oh, that's great. Thanks for hitting on that one. And one of the other questions, are custodial services kind of the easiest entry point from an operations or a rollout perspective, or is there kind of another way that you would expect banks and credit unions to get involved in this, Larry?
They're the easiest and they're the only entry point, because you really need to have some level of custodial services, even if that's custodied completely with a third party like a NYDIG, or if it's a partial custody where you're sharing the custody with Coinbase, or you've developed your own internal custody where you're custodying those keys yourself. Again, it's not dramatic. It's not a huge lift to be able to do this stuff. It seems technically heavy, but most of those vendor providers can kind of get you up into market within 60 to 90 days. So the solutions are already kind of pre-built, but yeah, you have to enter from a custodial services standpoint. And then that gives you the option of doing your trading solutions. That ultimately gives you the option of lending against this crypto, and it will just allow you to build upon it. I think what's important is thinking about the long-term use cases and all the things that ultimately your customers or members might want to do, is having a solution that is going to be one, out in the marketplace in time, but is going to be competitive, because we're going to see a lot of similar solutions launch next year. And so your solution, depending on the complexity, may or may not be as competitive. But longer term, we're going to see a lot of other solutions. And some of the solution providers may lock you into a fairly limited product set, whereas if you build something yourself, or you build it with a couple of vendors, you might have more flexibility to do a lot more with crypto going forward, as opposed to maybe just kind of hitting the easy button and going with one provider that might provide a simplistic solution.
That's great. Well, I know we're up against time here at the top of the hour. So thank you, Larry, for jumping in on those questions and any others we can kind of use for next time and add them into our presentation. So I just want to thank everyone again for attending the session today. We certainly hope it was insightful and encourage you to keep an eye out for the second webinar in our series here, as well as a new SRM white paper on this very topic. And we look forward to bringing more of this type of programming to our clients, our prospects, our partners through the end of the year and into 2022. So I would say until then, thanks again for attending. Have a good day. And please reach out to Larry or your SRM contact if you want to talk more about your company's needs when it comes to the crypto space. So again, thank you, and happy to have everybody today, and look for a follow-up with the recording of this session. And thanks again, Larry.
Yep.
Take care, everybody.